Hello, viewers, and welcome to the GI Huddle. I'm with Sam Swanell, Managing Director and Group CEO of PointsBet. Sam, thanks very much for joining me today.
No problem at all, Tim. Good to chat.
This week, obviously, there's only one bit of news that really I would ask you about. That's the sale to Fanatics of the US operations. To get straight into it, for some context, could you walk us through to start off with, when did you ultimately decide that that's it, you're going to sell the US operations?
Look, we've stated publicly that we've been in discussions with parties exploring our strategic options, not just in North America, but globally with our Australian business and our Canadian business as well. Look, it all comes down to what is the right outcome for shareholders, value maximising outcome for shareholders. We believe that this outcome is the right risk-adjusted value maximising outcome for shareholders. And by that, I mean, look, we've acknowledged that competing in the US is expensive. It's a high cost of doing business over there related to the partner fees and license fees that you need to pay, the state-by-state environment. And that does require a degree of scale in order to I think, deliver the economics that one needs to succeed. So look, it's become increasingly, I suppose, clear that's a challenge. I think the deal that we've struck with Fanatics is quite innovative in a couple of ways, because it's not just the headline price of US $150 million or Australian $222 million. It's the structure of the two-stage closing process as well. And what that basically means is post a shareholder vote, which we're aiming to have on June 30, PointsBet, bar $21 million US is removed from the ongoing funding needs of the US business. So obviously those funding needs are pretty material. So what that allows us to do is to collect $150 million US, less the $21 million that we will contribute, but it allows us to preserve the capital that we have on the balance sheet. At our last 4C reporting, we had over $250 million on the balance sheet, and I think we've flagged to the market come the end of the year that we'll have more than $200 million end of the financial year for us, which is June 30. So the deal can be looked at in terms of the price achieved for selling the US business, but also the cash that we retain on the balance sheet. And I suppose also the other element here is we did have some large commitments in the US. Our NBC deal, they were the type of commitments that were that was a great asset, but it's a great asset for a company that has a material market share and is heading in the direction that I suppose allows for a $50 million per annum investment to NBC. So to achieve the headline price, to retain the cash on the balance sheet, to be able to find a buyer who would take on those commitments, that was really the aim. When did we decide to do it? Well, it's all about finding a deal that works. So you're in discussions. If you get to a point where there's a structure that works, and we think this is a structure that maximises the outcome for shareholders. And when you think about at a closing of this deal, and we expect this deal to close around, in totality, the final closing around March next year, we're left behind with a business that we've said is going to be break even, heading towards profitability, with our Australian business profitable, offsetting the Canadian business, which is earlier stage in a sort of a capital light environment. So that really shows you that most of the loss or the burn that we were accumulating relates to the US business, the technology supporting the US business, and some of the corporate costs supporting the US business. So look, we came to this decision as what's best for shareholders, and we're really happy that this is a value maximising deal for shareholders at this point in time.
Mm-hmm. Were there any other offers on the table? Because you talked about kind of, you were in talks, and obviously there were reports of kind of talks with Fanatics previously as well, prior to this confirmation.
Yeah, I mean, we've acknowledged that we've had various discussions over the journey. I'm not going to get into specifics, but I think this, having reached the outcome here, this talks to the fact that the board has explored a range of possibilities, and this is the optimum outcome that we could achieve on behalf of shareholders in terms of the structure of that deal, headline price, retention of cash on the balance sheet, and a party that is able and willing to take on the commitments that the business had.
Mm-hmm. You've talked about the climate in the US for operators. I guess from the horse's mouth, just how tough is it? Because there were a few brands who simply just closed the US business, and the high cost associated. Is it just simply one of the toughest markets out there?
Yeah, I mean, look, we went in there obviously with significant aspirations, and we had some early traction. I think we're probably the only party outside of the US that did so. That got some traction in these first handful of years of the US market. I think obviously the market share that is consolidated in FanDuel and to a lesser extent DraftKings is significant, and I probably. I'm not sure anyone expected them to be as dominant or as strong as they have been. So, from a market share perspective, those guys are getting sort of stronger and stronger, and they can reinvest those dollars into continuing to grow their businesses. But yeah, I mean, it's the fact that we're in 14 states in the US. 14 states, and the costs that go with the demands of those different 14 states is very different than running one operation that covers 14 jurisdictions. There's 14 sets of costs involved. The fact that you need to pay partner fees in most instances for your license, whether that's a casino or a racetrack or whatever it may well be. So yeah, it is expensive as a baseline to do business, and you need a degree of scale to overcome the fact that the unit economics are a little bit more challenged. And if we compare that to, for example, the Canadian Ontario market, very deliberately, we've held on to our Ontario business. It leaves us with exposure to a North American market. We believe it leaves us exposure to the most attractive of our 15 North American markets, in that it has an acceptable tax rate. There's no partner fees. Obviously, it has, in that single jurisdiction, it has iGaming and sports betting sitting side by side. In America, we had 14 states, only 4 of which had iGaming. So you had 10 states that were sports betting only, and the 4 with iGaming. Having iGaming and sports betting sitting side by side obviously allows more efficient paybacks and a quicker path to profitability. And so we believe, that Ontario market, very deliberately for us, we've held on to that. We have, it's been recognised that one of the successes we've had of going into the North American market is the product that we've built, from scratch. And we made the acquisition of Bannock Technologies, which accelerated us in the live betting. So we have this market-leading, or top-tier live betting capability. We have an iGaming capability. We can exploit those in the Canadian market, and in Ontario in particular, in a structure where we believe that the unit economics are more favourable, and thus the path to profitability is clear.
Mm-hmm. You've kind of knocked off one of the questions that I had there. I was going to ask, the rationale behind keeping the Canadian business, but to maybe follow on from that, does that mean then long term, the Australian and Canada businesses are a focus, and US is sold off now, but Canada, you're kind of there for the long haul?
Absolutely. I mean, one of the realities of the US and Canada, when we were setting up and getting live in those 15 jurisdictions, is it's a big effort. It's a big demand in terms of resources and focus. Our Australian business has been EBITDA positive for the last 3 years. We really believe that with increased focus that we've started to provide on it in the last 12 months, we've finally delivered some product improvements that are focused on the Australian business. We've delivered some promotional efficiency type introductions that are really driving the performance of the Australian business. So, we believe that with the greater focus that comes from removing, that US business, the Australian business can continue to flourish. And equally, we think the combination of Australia and that favourable environment that is Ontario, Canada, that's something that we're comfortable with, that combination, I suppose. A lot of our technology baseline expertise and a lot of our trading expertise sits in our Australian business, so we'll leverage that into our Ontario business. Our Ontario presence in terms of headcount is very light, so that combination, I suppose, of the head office presence in Australia from a technology and trading perspective, really driving performance in Australia, but also in Ontario. So yeah, very deliberate keeping that combination. Mm-hmm. The more advanced Australian market, the more early stage Ontario market, we're really excited about what we can achieve in those two markets.
Mm-hmm. You mentioned, maximizing shareholder value, and obviously you wouldn't have done the deal if there wasn't, a degree of happiness with it. But it has been suggested that for Fanatics, perhaps, it's a bit of a bargain price, because all the state licenses that you kind of achieved, and you put a lot of marketing work. Obviously, you even, as you say, the NBC deal and signing, Shaquille O'Neal and things like this. Is I guess it might be difficult for you to say, I'm not speaking on behalf of Fanatics, but is that potentially a fair assessment?
Look, I don't think so. I mean, again, we're comfortable that we've explored all opportunities, to maximise value for shareholders in the US market, and then obviously the alternative was the status quo for us as a company if we didn't get away a transaction like this in America, and that is looking to raise capital as a loss-making company in the current environment where profitability isn't within touching distance. That's a very challenging sort of equation. So on the one hand, we were obviously motivated to find a solution to that, but we over a decent period of time, we have explored a number of opportunities. So I look at it this way, I think Fanatics have bought a fantastic baseline from which obviously they're looking to grow. What have they bought? They bought some great technology, great product, great people, market access, and in some instances, that market access has saved them some significant upfront license fees. But on the negative, has to be acknowledged, they've taken on some big commitments, and they've taken on a business that is, losing a decent amount of money. Even though we've found a bunch of savings and our revenue profile has been improving and our loss and burns have been decreasing, they're still taking on, a profile of a business that in the current environment isn't really popular. No one wants to be in a loss-making business at the moment with a longer pathway to profitability. They've taken on that business. Obviously they have great confidence in their ability to take what we've built and turn it into that 10, 15, 20% market share that they're aiming for. But no, I don't agree that this is a sort of a lopsided outcome. It's the reality of the world's changed a lot in the last 2 or 3 years. The types of valuations that were out there 2 or 3 years ago, you can argue were they real? I mean, our US revenue is probably 3 to 4 times now what it was when we were at peak valuation. So the market is the market. They put values on on where things are at, both taking into account the macro environment and the particulars of a company. But no, we got the best outcome that we could for shareholders. They were the natural buyer for the business, and I wish them luck in terms of taking what we've built and flourishing from here.
Yeah, as someone who's worked with them in this deal, and perhaps I guess as a future outsider to the market, looking in from Canada and Australia, do you think they have a strong chance of achieving that market share, given FanDuel, DraftKings, BetMGM, and etc. Because Fanatics has been talked about for a while, a lot of anticipation because of the old merchandising business model. I guess an objective view from yourself, do you think they can achieve and make headway?
Yeah, look, I probably don't want to provide too much commentary on that. I think they've got as good a chance as you would expect with, let's call it, the assets that they're heading off with. They've got obviously a good team. We think we've given them a great leg up, with what we're selling to them. It is tough, but I think they're well capitalised. They have those assets, I suppose, that have been well spoken about in terms of the 95 million database, and they've got relationships with the leagues, etc. So, I think they've got the right to be optimistic about what they can achieve. But who knows? Look, the FanDuel and DraftKings are already very large, and earning significant revenues, and no doubt they'll keep the foot down and keep trying to maintain that sort of moat around them.
A final question for me takes us back to PointsBet. Obviously, the US operations are a big week for you guys, a lot of work, and as you've said, a lot of conversations during and post deal. What's the future for you guys now? You mentioned you're focusing on the product. When we spoke a couple of years ago, there was already that emphasis on trading and the kind of the uniqueness of the product. What are your main plans in the Australian business and still in the Canadian one as well?
Yeah, I mean, we feel, again, one of the things that we have done well when we set off on that North American journey is what we've built from a technology and product perspective. And as part of this deal, Fanatics get sort of full copy and full access to what we've built, and we get full copy and access to what we've built, and we go our separate ways at closing. So both parties, I suppose, effectively own the technology and are free to sort of exploit it. We can't enter the US for 18 months and they can't enter Australia for 18 months. But other than that, where both parties are free to exploit the technology. So, we will still continue to be a technology and product-led company. That's one of the things, again, that attracted us about the Ontario Canadian market. There are restrictions there as it relates to promotions to get people to sign up accounts. The same things exist in Australia. We have some restrictions around, using inducements to get people to open accounts. What does that mean? That means, it's a more of a reliance on the quality of product and product marketing, and that suits us in both of those markets. So yeah, we've got this fantastic team and this product that we've built. We'll continue to develop it, and with the greater focus that we can provide on those two markets, being Australia and Canada, we have an expectation that Alberta will probably join Ontario in the legalised Canadian market, perhaps later next year. So we think that TAM up there in Canada continues to grow. It's already past $2 billion, I think, on the way to $2.5 billion of NGR. So a really attractive market. Australia's a $5 billion market. So there's plenty of TAM for us to work with, and with a greater focus. The US business, obviously, as we said, it was 14 jurisdictions, a large team, very competitive. You can imagine it's taken up a lot of thinking and resources on behalf of the PointsBet group. So, we're excited to get going in Australia and Canada with a greater focus. And yes, it will be a product-led strategy.
Mm-hmm. Well, Sam, thanks very much for your time. Congratulations on the deal. I know it's been a busy week for you, so hopefully you can get some rest, maybe some celebrations in at some point.
Thanks, Tim. Appreciate it.
Cheers. Thanks very much, Sam.